please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
After declining for 5 straight quarters, growth is finally moving upwards. So, is the worst behind us? Good evening and thanks for joining us on this special edition of the State of the Economy. I'm Lata Venkatesh. GDP growth for the second quarter is back above 6% at 6.3%. This is much better than the last 2 quarters, but this is still well below the 7% growth that were the rates in the quarters previous to demonetization. First, the top performers. Manufacturing growth has finally touched 7%, much better than the measly 1.2% clocked in the first quarter. Electricity and mining have also grown at a healthy pace. Electricity at 7.6%, mining at 5.5%. Mining is a good number because we have not seen this in many quarters when it was actually contracting. And finally, the ones that are the laggards. Construction at just 2.6% and agriculture at 1.7%. The tragedy is both these are the most employment generating sectors. Well, before we get to our elite panel of guests, here's a word from the Chief Statistician of India who has put together these numbers.
The introduction of GST, there is a measure of uncertainty being faced by a number of businesses in computing their tax liability. This has meant that the tax payments due in a particular period were not being paid on time. This created a challenge for us, but we looked at the data and the numbers which came and decided to stay with our practice of measuring it on cash basis. But as a consequence, it is likely that when the revised estimates are prepared, indirect tax collections for this period may actually be higher than what we have reported.
Well, that is the Chief Statistician telling us that actually these numbers may be a tad underestimated. Nevertheless, let's work with 6.1 GVA, 6.3 GDP in the second quarter, and joining us to discuss these numbers further are the Chief Economic Advisor at State Bank of India, Soumyakanti Ghosh, Samiran Chakrabarti, the Chief Economist at Citi, and the PMEAC member, Ashima Goyal. Welcome all three of you to the show. Well, Ashima, now that you would have had time to look at the numbers at leisure, does it genuinely signify that we are on an upturn, especially because we've got manufacturing doing 7%? I mean, actually, if you take away agri and the government sector, the non-agri, non-government sector has actually grown well, hasn't it?
Yes, it has grown well. So there are definite signs of a turnaround. The idea that the economy is going into a continuous decline has to be junked now. So, and I read a lot of positives in the data which are not immediately obvious. For example, construction growth is low, but there are indications that this low-income housing, there's a lot of interest in it among entrepreneurs. We're beginning to see signs of investment in that. So next quarters, that could also turn up. Then, as TC was saying, trade could be underestimated, and even with that, the numbers are quite good, suggests that the impact of GST and demonetization before that on the informal sector has waned, has revived. Because, big worry was there was a loss of unemployment, but was it going to be persistent? Or was it a temporary layoff and people would come back? So these numbers suggest people are back and those jobs are back. And if you see greater formalization, that would be good from the point of view of raising credit in the future. The other positive I see is really that the rise in imports has slowed. That was again that it's substituting for our production because of GST hitches. So probably manufacturing is back, imports have slowed. And again, the rise in manufacturing suggests that exports will rise in the next quarter, because to the extent world demand has gone up, and normally our exports really respond to world demand.
Absolutely.
But this time they've not. But that's because manufacturing. So now manufacturing has looked up. Maybe in the next quarter we should see. Then we're taking advantage of the rise in world demand to do better.
Okay. So, fine. That certainly is a bunch of positives that we should be proud of. Samiran, your thoughts. What do you see as the key positive takeaways, and more importantly, the key negatives, which I have not yet asked Ashima?
Well, I think the big positive is the manufacturing rebound. We were expecting the manufacturing rebound because we saw that in the company results for Q2 that they were much better than Q1. So we were expecting that. And the way we are forecasting now for the next 2 quarters, the GDP growth numbers should be around the 7% mark for the full year average to be about 6.5%. The challenge really is that even Q3 October has been a tad slow, partly a payback for the slightly earlier festive season in September. So maybe 1 month we will not get a good number. We will see what happens in November and all. The big issue is with respect to the construction sector, because it just not affects the construction number, but in the first estimate also affects the financing, real estate, professional services.
Correct.
In fact, real estate professional services is 75% of that. And that typically is just the GVA of the companies in that sector. So since that construction sector is not doing well, it's kind of a double whammy in 2 places in the GDP, and both those places have been lower than our expectation, making the overall number look a tad lower than what we were expecting.
But construction is not...
This is something which we have to look through. Going forward...
no, I was just saying that do you expect construction...
Going forward, the other worry would be agriculture because...
No, go ahead.
I was saying that going ahead in the next 2 quarters, there's a very strong negative base effect for agriculture, which would mean that the numbers could be lower on agriculture side. So that's also something which we need to worry for.
Okay. No, I was just saying that is there any reason to believe that we will overcome this low construction number? I mean, affordable housing is a small part of construction. We have still the twin balance sheet problem obstructing widespread growth in infrastructure. So do you think construction will improve? And in any case, do you think that we will get to that 7% mark if construction and agriculture lag? And even public administration?
Well, the issue is that construction was impacted not just by demonetization and GST, but also by RERA. So now people are getting adjusted to this new environment of dealing with things. So once this headwinds of these 3 things fade out a bit, I would expect that the construction numbers should also improve, not just on the back of affordable housing, but a more general construction growth. On your question about the government expenditure, the little bit of good news is that in the October fiscal number that has come up, the expenditure increase has been 16.5% in October, much better than what we had seen in Q2. So maybe the worst part of the slowdown in government expenditure is behind us. So I'm not that worried on the government expenditure front.
Fair enough. Soumya, what would you say are the trouble spots? We all agree that manufacturing is showing a bit of buoyancy. Gross fixed capital formation has grown by 4.6%, even if as a percentage of GDP it has not shown much improvement. Do you think that this is enough to take us to the pre-demon growth pace?
No, if you ask me about the somehow disappointing part of the GDP data, I'll just point out one trend which is really interesting. In fact, if we are trying to break down the deflators of GVA through the various sectors, and you found out that the GVA deflator is actually, if you look into the growth rate of trade, wholesale, transport sector, the nominal growth rate over the last 2-3 quarters has more or less remained same. I think that was around 11.5% in Q4 and it is 12.1% this quarter. But if you look into the deflator has actually collapsed from 5% to 2.1%. So that means, and the same has been the case with the finance insurance sector, where the deflator has actually declined from 7.3 to 2.6% over a span of 2 quarters. And even though the nominal growth has more or less remained constant. So that means that possibly the lower deflator is pushing up the GVA.
Okay.
So therefore, I think that there is still not enough demand in the system, and that could be a cause for concern to me.
Okay.
But if I just take out the positives from the data, I think that we just mentioned, the public GVA has expanded as the private GVA has expanded significantly, while the public GVA has actually contracted. So it's a more of a story driven by manufacturing growth rate.
How would the Reserve Bank respond to this? Would it look at this as subdued demand and therefore be somewhat dovish? Ought it to be a little dovish?
I think it's a difficult problem. What we are seeing is that possibly the rebound in growth is not fast enough to warrant a significant closing down of output gap anytime soon. So from that perspective, they should be somewhat comfortable. But at the same time, there are one-off things like vegetable prices, etc., which are going to push the inflation numbers beyond the 4% mark very soon. So if that's the case, then it becomes a very critical balancing act for the central bank to give an impression that it's not becoming too hawkish. We have to also keep in mind the fact that between the October policy and the December policy, which is going to happen now, there is a tightening in monetary conditions from the perspective of both yields going up, exchange rate appreciating a tad, and also the excess liquidity in the system narrowing down a bit. So keeping all this in mind, the central bank will have to balance it out in their statement without sounding too much hawkish or too much dovish. So a neutral path is what I would expect.
Okay. Well, Soumya, the same question I asked Samiran earlier, with capital, gross fixed capital formation at 4.1 and manufacturing at 7, do you think we are more or less across the hump and we will be getting to the pre-demo, the FY16 rates of growth?
No, I think that still it will take some time to reach the levels of the pre-demonetization growth, because one of the critical sectors which is basically is an indicator of whether we can lead to the pre-demonetization period is the finance sector, where bank credit and deposits actually plays a big role. And if you actually look into the CSO statement, that have slowed down significantly in this quarter if you compare it year on year. So that is one thing which we are closely watching out for. So therefore, any reverting back to the pre-demonetization level in the next 1 or 2 quarters will be difficult, even though my sense is that the manufacturing sector may continue to do well because of once the GST stabilizes. But I am a little bit skeptical on the services sector, because there is a lot of ifs and buts which is playing around over there, and my sense is that the growth as of now will be supported more by a rebound in the manufacturing sector rather than in the service sector, because remember that the government expenditure segment is unlikely to grow significantly in the next 2 to 3 months. We also have a huge base effect coming up in the government sub-segment.
Okay.
17% growth, I believe, in the Q4 of last year.
Okay. Yes, there certainly is a base issue over there. But very quickly, I want all three of you to give me 2 numbers. Second half GDP number and full year GDP number. Soumya?
The second half, we are actually working with an GDP number for the full year at 6.5%.
Okay.
So that means the second half number could be anywhere between 6.5 and 7%. Okay. And the GVA growth rate of around 6.4%. Okay. But there is a small caveat. The last year numbers could be revised downwards.
Oh yes, there is always that, but we will go with the base as we now have. Samiran?
Two economists generally don't agree, but in this case, we have a very similar number of 6.5 for the full year and about 7% for the second half.
Okay. Ashima?
Yes, I agree that we see improvement in the next 2 quarters, but it won't be sufficient to pull up the full year to 7, so it will stay below that.
Okay. That itself is very positive, considering the kind of 5-point-something numbers we went through in the past 2 quarters. Ashima Goyal, Samiran Chakrabarti and Shaumya Ghosh, thank you very much for joining me in this special coverage on the GDP. The important statement we are getting from our economists is that the second half could actually see a 7% average growth. Even if the full year is going to be 6.5%, it's important that we would have gone on to a 7% growth. The important point is if we can stay there in FY19. The key takeaway from the economists I just spoke with is that the Indian economy is definitely troughed out and headed for a 7% growth in the second half. I am now joined by the Vice Chairman of Niti Aayog, Rajiv Kumar. I just spoke to him a little while ago, and here's a slice of that conversation. The capital formation number coming in 4.1% higher looks extremely impressive, but as a percentage of GDP, it is still lower than our historical record. It's only 26% in nominal terms. So would you be happy with capital formation, or would you say that it is work half done?
Well, at 2011-12 prices, it's
28%.
It's not a very good one, but it's still 29.4%.
Yes.
Which is a little lower. I saw it as 29.4 right in front of me. Which is, as I said, not good enough, and it's actually weakened a bit. And we have had a peak of, I think, if I'm not mistaken, 37-point-some% in the past. So, but this goes back to the point that I was trying to make, which is that this is because the private domestic investment, had remained anemic, and that was because of the twin balance sheet problem that we very well know of. Now the government has taken some major steps in coming out. They've tried to address one part of the twin balance sheet problem with the bank recapitalization that is announced, and I think this will, along with the governance reforms of the public sector banks, you will see in the next few weeks this happening now at this time. And once that is done, and with all the things that I just mentioned to you about the ease of doing business ranking, etc., I expect, and I've just been in Hyderabad where I met a whole range of very leading private investors, and the mood has changed. The mood is beginning to change, and what they're telling me is that they are now looking forward to some capacity expansion because the consumption demand has picked up. And both rural and now beginning to, the urban demand. The only weakness has remained is that of the construction sector and of exports. And here, we discussed the construction sector already. On the exports is the one which I want, much more focus and attention
that's grown only by 1.2%.
And I think that will come. And here the RBI could play an important role. Sorry?
Yeah, the export growth is only 1.2%. That actually is the underperformer.
I didn't hear that. Yes. It's a huge underperformer, and that I think must improve, and that is where the RBI can play ball by trying to assure the Indian businesses that our rupee will not appreciate in real terms in the near future or in the coming future. In fact, I've been saying for the next 5 years. And to argue that the RBI should not intervene in the market and the RBI should not have a target rate, etc., I think it doesn't wash as far as I'm concerned. The RBI can intervene sufficiently to make sure that the differential inflation rate between our country and other countries actually is taken care of, and the rupee is not allowed to appreciate, and remain at its normal value, at its real value for the next 5 years. If you do that, you will take away the export pessimism from our economy. You will prevent the exports from being just remaining residual as they are, and you will reorient the whole economic activity towards more labor-intensive sectors, which is where the exports come from. So I think this is a huge policy shift that we need to make. And you know, Lata, that all successful Asian economies have got their success on the basis of a relatively depreciated currency. I'm not even asking for that. I'm simply saying, let the RBI please assure the Indian businesses that our rupee will not appreciate above its real value in the next 5 years. And that is where I think the RBI, I expect that RBI has the authority to do so.
Just one final question on this issue, Mr. Rajiv Kumar. Actually, we are underperforming in exports with a 1.2% growth at a time when actually the GDP numbers for the US has come in at 2 quarters at over 3%, 3.3 they announced, and Europe, OECD has revised upward the European numbers as well. And more importantly, even with our current level of intervention in the currency market, the US authorities are likely to call us a currency manipulator. Do you think really there's so much elbow room from the currency point of view?
I think there is an elbow room, and I don't think that the US authorities are going to call us a currency manipulator if they haven't called China a currency manipulator. And if they choose to do so, well, we'll have to live with it. But the point is that we have to take all the steps necessary to take advantage of the synchronized growth in the global economy at this point of time. Now, we are doing our bit of work in Niti Aayog by having established a task force on employment and exports, the recommendations of which will be coming out in very shortly and will be submitted to the Ministry of Commerce, which tackle exports, sectoral exports at a very granular level to debottleneck the supply side. And the Commerce Minister, you must have noted, has already announced that there will be some strategic intervention by setting up sort of establishments abroad. So we are doing what we are doing, and I think therefore RBI needs to do what is expected of that.
Okay. So final number from you, 6.9 in the full year, FY18, 6.8?
Between 6.5 to 7%.
All right, fine.
I don't think I can get more precise.
All right. Well, Mr. Rajiv Kumar, thank you very much for joining us. And with that, we wrap up our special coverage on the second quarter GDP numbers. Thanks for tuning in.